Investment banking is easily one of the most profitable corners of the financial world. Back in 2018, investment banks raked in over $39 billion in revenue, and that was just in the United States. If the term investment banking sounds confusing or intimidating, don't worry, you're not alone. Even people who work in finance sometimes struggle to explain exactly what investment bankers do. Still, when you hear about starting salaries around $140,000 a year, it's not hard to see why so many people dream of breaking into the field. Some are chasing the money and prestige. Others just want to understand how this mysterious industry actually works. But here's the truth. It's not nearly as glamorous as it looks in the movies. Behind the luxury cars and champagne parties is a lifestyle defined by stress and brutal hours. Some bankers grind over 100 hours every single week. Let's just say, there's a reason Patrick Bateman snapped in American Psycho. So what exactly is investment banking? Why does it make so much money? And how is it different from regular banking? To answer that, let's rewind to where it all started. In the early 1800s, American commercial banks handled many of the functions that investment banks do today. But during the Civil War, everything changed, thanks to a man named Jay Cooke, a financier from Philadelphia. In 1861, he founded what's considered the first American investment bank, created to help fund the Union's war effort. That made the U.S. government one of investment banking's earliest clients. At the time, the government needed to raise huge sums of money to keep the economy running and to fund major infrastructure projects like the railroads. To do this, they issued bonds, essentially promises to repay borrowed money with interest. Investment banks would buy those bonds, then resell them to private investors for profit. That simple model, acting as a middleman between borrowers and investors, is still the foundation of investment banking today. So where do all those billions in revenue come from now? It boils down to a process called underwriting. Investment banks purchase financial assets, known as securities, that have monetary value. They then sell these to other investors, earning a fee for managing the transaction. But here's the catch. If they can't find enough investors to buy, they have to keep the securities themselves. That's why investment bankers are often described as risk-taking intermediaries. Now, you might be wondering how that's any different from what commercial banks do. The key difference is in scale and risk. Commercial banks serve individuals and smaller businesses, offering things like mortgages and personal loans. Their profits come mainly from interest payments. Investment banks, on the other hand, deal with massive corporations and high-risk startups. They act as a bridge between companies that need capital and investors looking for opportunities, and they make their money through large transaction fees. Sounds like a dream business model, right? Well, not exactly. Investment banking's reputation took a serious hit after the 2008 financial crisis, one of the worst economic collapses in modern history. Here's the quick version of what went wrong. In the early 2000s, the Federal Reserve made it easier for banks to lend money by lowering interest rates. With more liquidity available, banks started handing out loans left and right, even to people who couldn't realistically afford them. These risky loans were called subprime mortgages, or in plain English, loans that were doomed from the start. To keep the money flowing, commercial banks sold their old loans to investment banks. Those investment banks bundled them together into giant financial packages and sold them to investors, without revealing how unstable they really were. It looked like a win-win at first. Borrowers got homes, investors earned returns, and banks kept selling loans for fresh profit. But once interest rates rose, the whole system collapsed. Borrowers began defaulting, foreclosures skyrocketed, and panic spread across the financial world. In a matter of months, the U.S. economy suffered its biggest crash since the Great Depression. What really happened was that investment banks built a massive bubble of bad debt, and when it popped, the entire global economy felt the shock. So does that mean investment banks are just villains in fancy suits? Not quite. The 2008 crisis wasn't the first, and it won't be the last. Financial markets have always gone through cycles of boom and bust. And despite the chaos, investment banking has played a huge role in building modern America. Without it, the railroads, the mining industry, and even the early tech companies might never have existed. And as we move toward a more sustainable, green future, we'll need investment banks again. This time, to help finance renewable energy and large-scale innovation. Some people believe crowdfunding platforms like Kickstarter could eventually replace investment banks. But that's wishful thinking. Crowdfunding can help small projects get started, sure, but it's nowhere near reliable enough to fund billion-dollar infrastructure or clean energy projects. Investment banks, however, already invest billions into alternative energy and cutting-edge technologies, and they'll continue to fund the next generation of world-changing innovations. Because at the end of the day, companies will always need investors, and investors will always need someone to connect them with opportunity. That's why, no matter how controversial it may be, investment banking isn't going anywhere.